Hey there, welcome back to my YouTube channel. Really appreciate you being here. It's a funny thing, earlier today I was doing some audio testing and there were multiple people that jumped in on those streams. It's something I didn't think anybody would see because it's not during my usual time slot, but to the real ones out there, thanks for showing up even for my test runs. So, and it happened a couple times too. Like I think I had to do 3 audio tests and each one had like multiple people in it. So thanks to you. So you get to see some behind the scenes stuff with like actual bad lighting, and I wasn't even like all done up or anything, looking terrible. But anyway, appreciate you doing it. Anyway, this is the actual video. If you're wondering if this is another false start, but anyway, yeah. So in this video, I've tested the audio, and I think I figured out the echo problem, got that sorted out. So I was watching a Clear Value Tax video, and it was essentially about the housing market crash in 2022. Is there going to be one? What's that going to look like? All that kind of stuff. So anyway, so I thought I'd do a reaction to that particular video. Without further ado, here we go. So this is Brian Kim with Clear Value Tax, but this is what he's talking about.
I'm going to share with you whether we're going to have a housing market crash or not. And the answer is we will experience a slowdown in the housing markets, but there will not be a housing market crash. You know why?
All right, so at this point, he's talking about, well, he'll get into it a little bit more, but essentially he's saying, is there going to be like a 2008 crash, like basically a popped bubble?
It's because we're not in a housing bubble. So I'm going to let you know what you can expect and my recommendations for you.
All right, so right off the bat, I'm going to disagree with him. He says we're not in a housing bubble. However, he'll get on to explain exactly what he means by that. Why I think that we are in fact in a housing bubble is because if you look at housing prices in 2019 versus today, they are hyperinflated, and not really because they deserve to be. The thing is, there's currently a housing shortage, and with the law of supply and demand, the number of people putting their house on the market is much lower. Therefore, it is driving demand up. That started in 2020 when COVID, quarantine, all that was going on. A lot of people were very hesitant to have people want to come into their property, you know, to do listings and showings and that kind of stuff. The other thing is that a lot of people just didn't want to move during that type of thing. So the available houses or the available properties on the market just weren't there. So they created this big competition for buyers, and the Fed wanted to try to help get the economy back on track. So interest rates for homes were super duper duper low. Like it was an absolute phenomenally good time to lock in a home loan. But as time has gone by, the inventory remained low. And then as people were starting to get more and more open to the idea of selling their property and buying a new house, moving, or even just being a first-time home buyer, a lot of those people were getting priced out of the market and they just couldn't afford it. So it put us back into a position of people still weren't going to sell their home because the cost to replace the home is just so much higher that nobody really wants to do it anymore. Coupled that with the Fed continuing to increase the interest rates to make home loans a lot more expensive, the number of people trying to buy homes right now is getting smaller. But anyway, because of the squeezed availability, what they higher demand for sustained like 2-year period of time, that just artificially, in my opinion, rose the prices of the housing market to a level that's unsustainable, and I think that has created a bubble. So I do believe that bubble will pop, but I don't think instead of a pop crash, I think it'll be more of a deflation, personally. But let's get into what he has to say.
Now I'm going to take you for a walk down memory lane, and this is going to be a revelation for the younger people here. Do you remember the housing market crash during the Great Financial Crisis? I do. And the conditions right now, they are not even remotely similar compared to 15 years ago. The housing market crash, so that was driven by irresponsible speculation, predatory lending practices, and foreclosures. Those are characteristics that are not here in this housing market.
All right, so what he's talking about here is there were a number of hedge funds that were going out and basically doing these lump offers where they take a whole bunch of basically bad applicants, people that they knew should not qualify for this type of loan. They would get them in large bulks and then sell them off to other financial institutions, saying that it's going to be a great profit. And then they would short those very same people that they knew were bad lenders. So basically what that means is they would, in bad faith, sell these loans to these other companies and then profit off of selling the loan and then know that the loan would fail. So they would short that particular loan, basically meaning when it falls apart, they gain money. So it was really bad. So they were basically predatorily taking on people that they thought would fail and paying their loans. And it screwed over lots of financial institutions, but it absolutely screwed over the individuals who were trying to buy these homes.
During the last housing bubble, lenders were giving loans to practically anybody. They were called ninja loans. So this is the lenders giving people loans with no income, no job, and no assets. Ninja loans.
Intended to
So
fail.
ever since they stopped doing that, homeowners today, they are more qualified compared to before. Homeowners have jobs and their average credit score is 750. In 2010, the average homeowner had a credit score under 700. So here's another thing, and this is big. In 2007, 13 million homeowners had adjustable rate mortgages. So this is when you get a loan with a very low interest rate temporarily. It's a teaser rate.
Yeah, so part of the practice would be like, oh yeah, it'd be one of those, what would it? A lot of like used car lots will do this, where it's like 0% interest for a year or no money down. It'd be like, no money down, it's okay, you can pay it off whenever you want it, you can do it. Take charge of your own dream, that kind of stuff. So these people taking these ninja loans should not qualify for this loan. There's no way that they can pay it back, and then they would be given this this teaser rate. So basically, like on the front end, oh, it's going to be just this really, really low rate, but then after that expires, it jacks the rate way up, and then suddenly they can't afford the rate, and then lo and behold, the house gets foreclosed on because they can't afford it. The whole loan falls through, and that's a chain reaction. So anyway, so that's part of what he's talking about.
And then the rate adjusts higher in the future.
Yeah,
This
exactly.
screwed
Cut
over
off little
10 million Americans when their rates adjusted in 2007. 13 million adjustable rate mortgages back then. Right now, it's only 2.5 million, of which only 1.7 million will adjust in 2022.
All right, so the whole premise of his particular point is that we are not in a housing bubble because it's not like the 2008 housing bubble. So the two are not similar, therefore it's not going to happen. So, however, like I stated before, we are actually in a housing bubble, but the reasons are very different. He's saying that there's not going to be a housing market crash. It's going to basically cool off. It's currently cooling off because the Fed is aggressively restricting the interest rates, which what that does is it lessens the buyer pool. So with the law on supply demand, there is extremely low supply and the demand is higher than the supply, therefore the price goes up. However, the demand is getting choked off because most people that wanted to buy a property are getting priced out, and then the people that are still going to buy anyway are getting loans, but in order to get approved for a loan, it's going to be a lot more difficult, and more importantly, the cost of that loan is going to be significantly higher than it was a year ago. So it's disincentivizing people to buy homes, and therefore the buyer pool or the demand is shrinking and shrinking. It's almost hit an equilibrium to where they're about the same, and eventually it's definitely going to decline. It's already cooled off. It's not nearly the seller's market it was probably even a month or two ago. So the Fed is supposed to have 3 more interest hikes in the next 2 quarters, which is a lot. They're already being a lot more aggressive with their interest hikes than was ever expected. Originally, it was supposed to be 4 interest hikes the entire year, and that's already been surpassed. So the supply will continue to decrease. The demand will continue to decrease, and then what happens next will be up to the supply. And that's where I think things get tricky. There was talk of going to be a soft landing. It is possible. But the last time this kind of situation has happened, or not the last time, but of the past 14 times the Fed has attempted to do what they're doing now, they've succeeded in a soft landing. I think it was 3 times. So out of 14 times, they succeeded 3 times, and the other 11 times we had a hard landing and went into a recession. So, not great odds, not good odds at all. As far as a housing market bubble burst, I think it's possible, but I don't think it's. I personally don't think that's how it's going to play out. I think it's going to be a deflation. I think housing rates are just going to start to climb down. It'll get down to 2019 housing levels. It's what my guess is going to be, possibly lower. The thing that I think would cause a housing market pop, or a crash specifically, that'd be a better term. Thing that I think would cause housing market crash would be if a lot of people who are sitting around like on standby waiting for the market to crash see that housing prices are dropping, and they all panic sell. And they're thinking like, oh, this is my last time to sell while my house is at the highest value, which is correct. Then you'll flood the market with inventory with no buyers, and that will just drop the rates. So my other guess is if there's a large real estate institution that is holding a lot of property and wants to devalue all these other real estate institutions that have been buying aggressively and overpricing and overpaying for all these properties, if they want to decrease the value of all these other competitors, then they'll suddenly put all of their properties on the market and then drop the rates. So, or a combination of those two things. That's how I think a housing market will crash as far as the housing market's concerned. Now, as far as an economy or an economic collapse, that's a totally different story. There are theories on that one and how that could happen, which are very plausible. We do have very similar makings of the 2008 housing market crash, except it involves the stock market and, I want to say repontification, rehypothecation. It involves that. Basically, somebody buys a stock, is like, hey, I'll lend you this stock, and then you can short it or whatever. And they're like, cool. So they take that lend stock. It's like, hey, buddy, I'll lend you this stock. They're like, cool. Hey, buddy, I got this. I borrowed this stock. I'm going to lend this stock to you. And then basically it daisy chains the same one group. It's called rehypothecation, and it's really sketchy. Creates a house of cards pretty badly, especially if one of those gets yanked out. Then it brings the whole rest of them down. Anyway, that is happening on a very large scale in the tunes of like several $1 trillion throughout our entire economy. So if that falls apart, we're going to have a much worse ride than the 2008 housing market crash. But I don't know that that's going to be a likely thing that will happen, but it's a possible thing that could happen. But anyway, as far as Mr. Kim's concerned, he is correct. We are not in a 2008 housing market bubble. It's a different situation. But I disagree. I think we are going to see a deflation and a decline. But a crash, I don't know. Personally, I think it'll probably happen in the wintertime. So like late October, sometime November, early to mid-December, I think is when it'll begin to happen. And then I think we'll see the full effect of it come like February-ish. I think that'll be when the decline really starts to happen. So anyway, those are my thoughts on this video. I think I'm going to start doing more stuff like this. I'll probably do more breaking point news, some of my thoughts on what they have to say on some of their videos. They do a lot of doom and gloom. Actually, they don't do a lot of doom and gloom. They just do a lot of reporting of the news. But then a lot of times they're like, So this is a stinky situation because of these candidates, and that's what we deserve. And it's just very nihilistic, not doom and gloom. They sometimes have very nihilistic on the current state of politics. And I would like to address some of that pessimistic outlook. So I do believe there can be change. I think change is coming, and I want to do my part to make it happen. So anyway, that's all I've got for now. So really appreciate you being here and hanging out with me. So for now, take care. Bye-bye.